Hi, this is Peter with Buying Ready. So, I'm the reason I'm laughing. I still haven't thought of the name of this thing. By monthly newsletter video segment. Yeah, welcome. Okay. Uh, Today we're going to talk about 6 things not to do when you're applying for a mortgage. So, 2 weeks ago, my lender, uh, Esther, sent me a piece of article. I think it's important enough that I'll probably put it along with my other training videos. So I'm gonna make a video about it, and if you want to see my other training videos, want to talk about the buying process, want to talk about the closing costs, want to talk about uh, like uh, how do you gauge an investment property, that type of things, just let me know. I'll send you an email, and let's dive right in. So it said when lenders review your application, it's likely to they like to see consistent in your finances. Right? It's pretty trivial, right? So if you don't have consistent uh, income, you don't have consistent your down payment is, you may not have it a month ago, you have twice as much like 2 3 months ago, they likely to ask questions. So number one, do not make major purchases like furniture, appliances, jewelry, vehicle, and vacations. Pretty simple, right? So everybody has loan to income ratios. If you're at the borderline, even if you're not at the borderline, let's say you can only borrow $400,000 on a $500,000 purchase, and you're at the borderline, you make X amount of money, and by the time you're pending on the house, before you close escrow, you buy a car, and your payment becomes another $500 a month, and oops, you don't qualify for the loan anymore, and that's a big no-no when you are trying to buy a house. So don't make huge purchases. And number two, well, this is really trivial too. Do not quit your job. Do not change your job, right? So if you are getting a promotion, it's okay. Okay. No job, no money, no money, no mortgage, no mortgage, no house. Pretty simple, right? Number three, consult your mortgage professional before withdrawing, depositing, or moving large amounts of money in or out of your bank accounts. So a lot of time is not okay to do it, just because each time you have a big amount of money moving in or out, the bank require you to write an explanation letter. I have seen as little as like $600, $700, and they were like, "How come you move? How come you wrote a check for $700?" Of course, it depends on the bank, and if you can explain it, it's okay. But if you have to write 50 to 60 explanation letter, and two or three doesn't pass, that may means your loan is not approved. So one trick I teach my clients is 2 3 months before you are buying a house, put the down payment and closing costs in another bank account with another bank. So if you usually bank with Bank of America, go to Chase. Just put all the money there. Wait 2 months, then you have two really clean, plain statements. And the other account, if they don't ask, it's okay. Just don't show it to the bank. They As long as you have enough that come in, they won't ask too many questions. So that's one trick that we advise our clients is. What number am I? Number four. Do not pay off do not pay off debt and collections unless advised by a lender that you trust. So the reason why you don't want to pay off debts is, I give you the same example: $500,000 home, $100,000 down, $400,000 mortgage. If you use $10,000 of your down payment to pay off your debts, it may sound like a good idea, but now you have to deal with less than 20% down. Your loan dynamic will be totally different. Your down payment is under 20%, so you have to pay primary mortgage insurance, and stuff like that. That's why you need a lender. That's why that you know that's what they do for a living. They know exactly what to do to save you money that way. Sometimes they ask you to pay for some of the money, some of the debts off. Sometimes they ask you to hold off until your house is purchased, and sometimes they ask you to pay it off. But they know how to gauge between down payment and uh, loan to income ratio. Number 5, avoid using cash for good faith estimate. Cash is difficult to verify and could result in closing delay. I've never happened to me because nowadays it's getting so darn expensive everything, and 3% closing cost is like $30,000, right, for a $1 million home. So it never happened to me, but keep in mind, don't do it. And if it is hard to verify, then you don't want any delays, especially now. It's a seller's market. If you're delayed, then they sell it to somebody else, right? Number 6, don't have your credit report pulled so many times. You can hurt your credit score. Pretty truthful as well, but I heard it both ways. Another story is if it is pulled from the same type of credit. If you get a mortgage inquiry from 3 banks, as long as it is within like 2 or 3 months, then it's okay. But I guess it's better safe than sorry, and just get a credit report from one person, one lender, and just shop lenders, giving them a copy of it. In that way, you don't have to pay 3 different credit reports, and you know your score already. Then it's safe. But don't go around and apply for Macy's card, Target, and stuff like that. So I'll put the PDF file in the e-newsletter as well. So hopefully you learn something from it, and I'll see you back in 2 months.